We're going to end this week's modules with a general discussion of what causes bond yields to change and what also causes bond return or bond mutual fund returns to change over time. In general, the returns on bond mutual funds increase as interest rates decline. And what's happening here is that as interest rates or yields decline, bond fund prices increase. So if we're selling a bond on the secondary market and yields go down, the price of that bond goes up. That's how um, the market causes those yields to change, is by having the price change. So as yields and interest rates go down, bond prices go up. So if we're holding bonds in general, if we're in a declining interest rate environment or a declining yield environment, we'll have higher returns on bonds and vice versa. We have been in a declining yield environment or a declining interest rate environment since the early 1980s. And that's illustrated on this overhead, which shows the yield on 10-year Treasury notes over time. And again, we could have graphed 3 month, 1 year, 2 year, any particular maturity along the yield curve and gotten the same side type of graph. But as you can see here, Treasury yields have decreased from roughly 14% in the mid 1980s or early 1980s down to their current low levels. Currently, we're having the yield on this 10-year Treasury note at between 1.4 and 1.5%, a very low return historically, and there's actually not much further it can go down, as you know, you can't go below zero on these returns or these bond yields. So we're pretty close to the bottom. Although every year we've said that, we've seen these things decline some more. But it's pretty safe to say that over the last, since the mid to early 1980s, so the 90s, 2000s, and 2012, or the last 30 years, we've been in a declining interest rate environment, which would have generally provided headwinds for bond returns to be positive, or that would have been a positive factor influencing bond returns. In recent years, probably since the early to mid 2000s, you can make the argument that the Fed has been contributing to these low interest rates. And in general, there are ways in which the Federal Reserve Bank can increase or decrease interest rates. And the most obvious way that they do that is by influencing the money supply. And as that money supply increases, interest rates should decline, with the key caveat there that that's absent inflation. The usual way Fed controls money supplies and interest rates is to go into or set the federal funds rate by using overnight borrowing. If interest rates are too high, in the Fed's opinion, they will buy short-term treasuries bills, thereby taking treasury bills out of the circulation, causing the price to rise and interest rates to fall. And if interest rates are too low, then they'll sell short-term treasury bills, and having the opposite impact. Currently, these funds or these usual means have been exhausted, because the nearby interest rates, as you can see by our tracking example, those 1 month notes are about as close to zero as you can get. So the Treasury has been, or the Fed has been using various means of quantitative easing since 2008, with the last one being buying longer term treasuries and asset-backed securities in the hopes of lowering or flattening the yield curve. That up to this point has been successful, keeping interest rates low. That would have the impact of making bond fund returns higher, but there's concern now that the Fed may or can't at least cause interest rates decline anymore, and in some day may actually have to let interest rates increase. Right now, there is some concern that we may be headed into a rising interest rate environment. And again, that concern exists, but it hasn't happened up to this point. If we ever enter into increasing interest rate environment, we would expect to see bond funds to have low returns or even negative returns. And again, if we see something like a increasing interest rate environment, we might be seeing individuals drop out of bond funds and holding those firms for those funds in some other assets. And again, the reason why they would do that is to avoid capital losses that could occur if we enter into a rising interest rate environment. That could happen in the near term if the Fed decides to tighten money supply. The economy become becomes to begins to perform pretty well. The Fed decides to tighten money supply, and that would lead to a rising interest rate environment. The other alternative is that inflation could occur, and that would be in general be a bad thing, and that would result in rising nominal rates, interest rates to increase, which would then further lead to um, um, bond funds having negative returns. Again, there is that concern that this exists, and that concern has pretty much been there since 2009. Having said that, the last couple of years, as you can see by looking at previous returns on the bond funds that you're collecting for your homework too, they've done pretty well in the past couple of years. So while there's that concern that exists of a rising interest rate environment, it hasn't happened yet. And if we kept funds out of bonds, we've foregone some attractive returns over the past couple of years. Just to summarize here, overall yield environment has a large influence on bond returns, and again, a decreasing interest rate or yield environment causes higher bond returns, and a increasing interest rate environment will cause low and maybe even negative bond returns. Um, those general factors cause, if you're in the bond investment world, to be very much looking at what overall interest rates are doing, and then you can look and or think about how individual debt instruments or corporate bonds perform based on what's happening to their individual risk, but lower and higher interest rates will impact all debt instruments. And right now there's concern over rising interest rates in the future, which would cause low bond returns, and that causes a negative for holding bond returns currently.